Welcome to the deep dive. Today we're attempting something a bit different, a financial translation project, you could say. We're going to dissect the structure and, well, the financial health of JD.com Inc. That's the big Chinese e-commerce player listed over on the NASDAQ as JD. And we're not messing around with analyst takes or news clips today. Nope. We're going straight to the primary sources. First source material is basically the rule book for any company listed in the U.S., the SEC filings. We've got the big annual one, the Form 10K. We also have the Form 20F, which is, the specific annual report for foreign companies like JD. And then the latest quarterly update, the Form 10Q. It's hundreds of pages of really dense stuff, legal and financial details. But our job is to pull out the key bits for you.
Exactly. And that's really our mission here, because for a company like JD operating in China, which is, let's face it, a complex, high-growth, highly regulated place, these filings are just critical. They don't just show you the numbers, the financial strength, which is definitely there. They also reveal the unique governance structures and the political risks. These things make JD fundamentally different from, say, a typical U.S. company. We need to make it clear what these documents actually imply, especially about the risks for shareholders and the company's, long-term direction. We'll try to keep it easy to follow.
Okay, perfect. Let's unpack this then, starting with the big picture. The annual view will begin with the Form 10K for the year ending December 31st, 2023. So what does this huge report tell us fundamentally about JD's financial state?
Well, the 10K definitely set a strong baseline. It confirmed a pretty significant growth year over year, not just in revenue, but crucially in profitability, too. And when you sort of dig into the details, the footnotes and all that, you see it's not just about selling more stuff. It really confirms that their whole model, combining direct retail with their own logistics network, it's actually delivering strong operating leverage. So it backs up their strategy, their position against competitors in the market.
Okay, strong numbers, that's good to hear. But the 10K is also where they have to lay out the legal plumbing, right? For JD.com, we absolutely have to talk about the variable interest entity structure, the VIE. People mention it a lot, kind of generically. But what does the 10K specifically tell us about what that means for someone holding JD stock on the NASDAQ?
Right, the 10K makes that distinction really clear. It's crucial. When you buy JD stock, you're not buying shares in the Chinese operating companies directly. You're buying shares in a Cayman Islands holding company. And that company controls the actual businesses in China through a web of contracts. Those are the VIEs. It's basically a necessary setup. It's how they navigate Chinese rules about foreign ownership in certain sectors, like tech and e-commerce. The filing spells it out. Your ownership stake is based on these contracts. It's not direct equity in the underlying Chinese assets.
So is that just like an accounting thing, a formality? Or does the 10K talk about real scenarios where a NASDAQ shareholder faces different risks than, say, owning stock in a U.S. company?
Oh, it's much more than a formality, definitely. The risk factors section hammers this home. For instance, think about this. What if Chinese authorities challenge the legality of that whole VIE contract structure? Or what if the local Chinese management just decides to breach those contracts? The U.S.-listed holding company, well, it has pretty limited legal options within China. The 10K basically admits, that these contracts rely on how local Chinese courts interpret them. That creates a built-in governance risk.
That structural piece is, it's a huge factor. And speaking of risks, you mentioned the risk section. The 10K has pages on potential problems. What were the really standout risks JD flagged about the regulatory situation in China specifically?
Well, they highlighted two big ongoing concerns. First, there's the constant shadow of antitrust enforcement. JD is massive, operating across retail logistics. So the threat of new rules targeting monopolies or how they use their market share, it's always there. It could really hit their growth plans. Second, and this is becoming increasingly significant, is data security and cybersecurity regulation. Things like data localization rules, rules about transferring data across borders. This hits their core operations, managing a global supply chain, reporting data internationally. It gets complicated.
Okay, so those major risks are baked right into the 10K.
Got it.
Now, let's shift to the Form 20F. JD files this one for its annual report because it's technically a foreign company. How does the 20F add to what the 10K tells us, especially for investors focused on governance?
The 20F is kind of like the global governance blueprint. It's designed to give you that comprehensive view of how the company runs, its specific risks, and importantly, how it lines up with, or maybe differs from, U.S. corporate governance standards. Yes, it has the audited financials, just like the 10K in essence, But its real unique value is that deeper dive into the structure and, importantly, the management's own story. So if you're trying to get your head around a 20F, there are maybe 4 key areas to look at. Item 3 is a good start. That gives you the whole organizational chart, basically, the principal activities. It's the map showing how the Cayman Company connects to those VIEs in China. It defines the legal setup.
Right, that sounds like essential reading to grasp what you're actually investing in. Okay, after the structure map, what about management's own take on how things are going?
That's item 5. It's usually called something like management's discussion and analysis or operating and financial review and prospects. MD&A for short, sometimes. This isn't just the raw numbers. This is the official narrative from management. They explain the trends, why things changed, why they spent money on certain things. For instance, you can see them talk about investing in logistics tech here, and then you can connect that directly to the efficiency numbers we see later on.
And the proof behind that story, the audited numbers.
That's item 8, the audited financial statements. Your balance sheets, income statements, cash flow statements, all checked by outside auditors. So the hard numbers. But I'd also flag item 16 as really important for a company like JD.com. This covers corporate governance practices. See, as a foreign issuer, they can get exemptions from some NASDAQ or NYSE rules. Item 16 spells out those differences. And often these differences relate back to how that VIE structure affects things like board independence or shareholder voting rights.
That's a fantastic quick guide for pulling the key info out of a 20F. Okay, so now we've got the long-term view, the structure, the risks from the annual reports. Let's see how the company's actually doing now. Is management delivering on that plan? Which brings us to the present. The quarterly update from the latest Form 10Q. This one's for Q2 2024.
Right, the 10Q is where you see the execution. And yeah, it confirmed that the positive momentum they built up last year wasn't just continuing, it actually seemed to be accelerating a bit.
Okay, specifically, the filing showed a clear revenue jump compared to last year. But can you tell us what drove that? Was it just selling more things, or did things like their premium services play a role?
The filing points mostly to strong performance in the core areas, so retail and logistics. That suggests they're gaining market share, keeping customers loyal. But maybe even more important than just the revenue growth were the signs of improved efficiency. That's key.
How did the 10Q actually show that efficiency? Saying margins improved is a bit vague, right? Does it give any clues about where those savings are coming from?
It does point to better operating and net profit margins, mainly through better cost management. For a huge e-commerce operation like JD, this usually means a couple of things. First, you'd look for real, measurable savings in the logistics chain. Think like making last-mile delivery cheaper or getting smarter with warehouse tech. Second, getting better leverage on their overhead costs, the general and administrative expenses, or G&A, even as revenue skyrockets. It suggests those big strategic tech investments they talked about in the 20F, they're likely starting to yield results now by lowering the cost to sell each item.
Ah, okay. So that link between the long-term plan in the 20F and the actual results in the 10Q, that's really important to see. Now, what about cash? The 10Q mentioned strong cash flow from operations. Where's that money going? Are they hoarding it or putting it to work?
That strong cash flow gives them a ton of flexibility, which is great. The 10Q noted it's being plowed back into the business, specifically supporting investments in growth think, tech upgrades, and also strategic acquisitions. And this is really important because it shows they're not just playing defense, cutting costs. They're actively using their financial strength to build a wider moat around their business, especially, against rivals like Pinduoduo. They're basically reinvesting profits to cement their reputation as the maybe the more reliable, high-quality e-commerce option.
Okay, so let's try to bring this all together. We've got structural limits detailed in the 20F, we've got financial muscle shown in the 10K, and we see strategic execution in the 10Q. If you had to boil down these hundreds of pages of dense regulatory text into, say, 3 main takeaways for someone listening, what would they be?
Okay, 3 takeaways. First, the financial strength conclusion is, well, it's pretty clear. JD.com shows really strong revenue growth, healthy profits. And that's backed up by that integrated business model, retail plus logistics. It means they're less reliant on others and have more control over the whole customer experience. Second takeaway. The strategy is clear and they seem to be executing on it. They're making those heavy strategic investments in tech and infrastructure. And as we saw in the 10Q, that's leading to efficiency gains and should help them stay competitive in what's obviously a really fast-moving market.
And the third takeaway, the factor that always seems to hang over these cross-border investments.
That's the watch factor. The Chinese regulatory environment. It was explicitly named as a key risk in the 10K, remember. Investors just have to keep in mind that government policy shifts on antitrust, data rules, foreign ownership can potentially impact everything they do. It doesn't matter how strong the balance sheet looks on paper, that regulatory uncertainty is the lens you have to view all the financial data through.
All right. Before we wrap up, let's quickly look at the market context, just checking the stock snapshot. As of the last close, JD on NASDQ is trading around $35.10. Some typical daily movement there.
Yeah, and the context is important. It's been trading in a range roughly $25 to $45 over the past year, so it's shown some resilience given the strong cash flow we saw confirmed in the 10Q and those efficiency improvements we talked about. While the current price probably reflects the market trying to balance JD's clear operational strength against those structural risks, the VIE setup, the whole China regulatory picture. It's a balancing act.
Well, that really was a deep dive. We've translated those complex SEC filings, the 10K, 10Q, and 20F, into, hopefully, some clear takeaways on finance and structure. So now you should have a much better handle on JD.com's financial health and its unique structural realities.
And maybe just one final thought for you to consider, building directly on what we found in these documents. We established JD has strong financials, great cash flow, confirmed by the 10Q, no argument there. But think about this. Given that unavoidable complexity of the VIE structure laid out in the 20F and that ever-present uncertainty around Chinese regulations, how does the fact that their operational control is purely contractual fundamentally change how you assess the long-term risk to your capital, especially compared to a U.S. company reporting similar numbers?
That's the core question, isn't it? That legal gap in actual ownership often drives the valuation difference in cross-border investing. Something to think about. Use this knowledge to start digging deeper into those systemic risks yourself. Until next time, keep looking at the sources.